Open any financial app in April 2026, and you will see two completely different realities crashing into each other. On one side, the global economy is noticeably decelerating. The International Monetary Fund projects growth will drop to 3.1% this year, weighed down by fractured supply chains and rising geopolitical tensions. But on the other side, Wall Street is having a party. Major indexes like the S&P 500 have been hitting all-time highs, driven by aggressive corporate capital expenditures. South Korea captures this contradiction perfectly. Despite the grim global forecasts, its economy expanded by 1.7% in the first quarter, the fastest pace of growth recorded there since 2020. If you look at this split screen and try to guess whether the whole system is booming or busting, you're going to make the wrong bet. The reality is far more specific. Let's look at the downward pressure first. The traditional physical economy is taking a hit, primarily because of prolonged conflict in the Middle East. The friction is concentrated around key transit points like the Strait of Hormuz, a critical bottleneck for global shipping. When vessels can't move freely through this narrow waterway, millions of barrels of oil get delayed. This trapped energy supply immediately translates into higher prices at the pump, driving up temporary inflation through the first half of the year. For countries that rely heavily on raw energy imports, this is a serious problem. Entire industrial sectors, especially petrochemicals, are facing supply shortages and shrinking margins right as we move into the second quarter. Rising energy costs and fractured shipping lanes are weighing heavily on the traditional industries that usually dictate the health of the global economy. Yet, while those traditional heady industries struggle, a massive counterforce is pulling the data in the opposite direction. Corporate demand for AI infrastructure is currently acting as a shield for the financial markets, driving outsized earnings for a select group of tech companies. You can see the exact economic output of this demand in South Korea's recent growth spike. The country is exporting a record volume of advanced semiconductor chips and IT components built specifically for AI systems. This chart clearly maps out the divergence. We have an aggressive, steep upward trend in tech and semiconductor exports on one side, moving in the exact opposite direction of traditional manufacturing output. A single hyper-growth sector is pulling the data so hard that it effectively hides the decline of the broader industrial landscape. Economists call this a K-shaped recovery. There is no single economy right now. The top arm of the K is riding the AI wave, while the bottom arm is fighting supply bottlenecks. This divide creates a complex problem policymakers call chipflation. Prices are forced up simultaneously from two completely different directions. Energy shocks push basic costs up from the bottom, while insatiable demand for AI hardware pulls tech prices up from the top. Central banks rely on broad economic averages to decide whether to raise or lower interest rates. But when the data splits this aggressively, their standard tools become paralyzed. The Bank of Korea navigates this exact dilemma, weighing a rate hike later this year despite severe stress in the manufacturing sector. They can't simply cut interest rates to provide relief to struggling industrial companies. Doing so risks pouring cheap money into the hyperactive tech sector, making inflation much worse. The headline numbers of 2026 are an illusion. Protecting your assets requires looking past the average and figuring out exactly which side of the divide your portfolio belongs to.